Hey everybody, welcome. My name is Matthew. Thank you so much for joining. We are continuing on with our series on the United States national debt. In the last couple videos, I showed you a percentage of the national debt in a proportional trailing 12-month basis for taxes, the deficit itself, that is an increase or decrease in the debt, and the interest rate. How much are interest payments to the government as a proportion of the debt? That's what the interest rate is. A lot of numbers here. All right. We were as high with taxes as we received, we the people, received 65% of the national debt in taxes when the debt was only $1 trillion in the early 80s. We had an increase in the deficit as high as 282% during the Civil War. All right. And obviously as a nominal value went up even more, but as a percentage that decreases. Okay, this is trailing 12 months. That's what you have to understand about these lines. And we had an interest rate, which is, I don't have the full length, but it went from low twos in the post-World War II times to over 15%. This is the blended average effective interest rate on all government securities that the government has to pay out to its investors, to its creditors. In the early 80s, went up to 15%, to now we bottomed in the low twos again during COVID, lots of money printing, to now we're moving up to 3.2%. So taxes, deficit spending, interest rate, lots of lines on the chart. Now I'm going to show you the final component that I told you I would talk about that relates to the national debt, and that is how much of the national debt is being printed. See it right there in gold? Printed. You might actually think that this is lower than you expected, and you would be right. It is lower than most people expect. So let me take off tax receipts, the deficit itself, and interest rate. Remember, we are looking at a trailing 12-month percentage of the debt itself. That's what this number is. All right, so increase or decrease over the trailing 12-month periods of whatever the debt was 12 months before. That's what all these percentages mean on the right-hand axis. Federal Reserve was created by Congress and bankers in 1913, opened its doors in 1914. As I've talked about, and just zooming in very, very quickly, we had central banks here in the early 1810s, 1820s. We did not have it here after Andrew Jackson paid off the debt. We had a huge spike in debt during the Civil War, but even these periods where there wasn't a central bank, which was like here, we had two central banks here of the United States, which was actually the second and third because we had the Bank of North America as well in the colonial times. You don't need a central bank to increase debt, all right? You can see it happened here. You can see it happened here. You also don't need a central bank to pay down debt, which Andrew Jackson did both. When we get to the 20th century, though, we can see that the peaks are pretty large on nominal figures. And we do have a central bank at that point. Okay, so we don't need a central bank to increase debt, but we did at these points. But remember, what is an increase in the debt? An increase in the debt is simply adding up all of the prior years where you've had a shortfall from the government's perspective. The government takes in taxes. All right, I'm not going to say taxes are a fun thing to pay, but if you're going to balance budgets, taxes are your income. And whatever you spend money on, roads, defense, agriculture, that's your expense line item. And every year, every month, doesn't matter which frequency you pick, typically using a trailing 12-month basis is easiest. Every trailing 12 months, if you spend a little bit more or a lot more than you take in taxes, that's a deficit. Add up all those deficits, you get the debt. Okay, so again, you don't need to print money to raise the debt. You don't need to have a central bank to raise the debt, as I showed you in the 19th century. Okay, you don't need that. But if we look in here, zooming in now in the period with the Federal Reserve, roughly the World War I, World War II periods, we see a huge increase during World War II when the United States entered World War II. This is actually not that much money printing, relatively. Okay, how did the debt itself increase? Massive, right? The deficit spend, which is an increase in the debt, it can also be negative, right? Like it's coming down here after World War I. Look at the deficit. Let's take off the print. I know we've already showed you this. We're decreasing the national debt here. So that's why this is a negative number, 5-6% a year. Here, the rate of increase is falling, but it's still increasing. That's why this spike is lower. But you see that at the peak, we increased the debt 88%. We still increased it as the line goes down, but this is trailing 12 months. Okay, so we're increasing it, 70%, 56%, so on and so forth. That's how it works. But look at the print. Look at the money print component. That is how much the central bank prints money to buy a proportion of that debt. Much less, much less. In fact, during this period, during the Roaring 20s, which they like to say is practice, they didn't really figure things out till the 70s or the 80s. You see that it was kind of wobbly. All right, let's take off the deficit itself. So you see what I'm talking about. The Federal Reserve only increased their holdings of United States government debt. That means they directly printed money to the tune of 1% of the debt. 1%, 2% of the debt. And they actually decreased it during these periods where perhaps they thought it was too hot. So 1%, decrease it down 0.8%, up 2%, down 0.8%. Then you get to the Great Depression. And now look, this is another interesting thing to show you about with economics. It's more complicated than what you might see on the surface. The national debt was falling all during the Roaring 20s. We were paying down debt. Taxes were roughly 20% of the budget, and the deficit, as we see, is below zero. That means it was a surplus. So we had a surplus. We were spending less than we were taking in as a percentage of the debt on the trailing 12-month basis. Yet we still had a Great Depression. All right, so that's a video for another time, but the short answer is the Federal Reserve was lending to a lot of banks cheaper money below market rates. That's what caused the Great Depression. Ben Bernanke himself has said that. It's another video. I've shown it before. We'll show it again. But you can't actually tell that we're going to have a crisis here on the eve of the Great Depression just by looking at these numbers. There wasn't a lot of money printing for the government, and the government itself was paying down debt. Good thing. So it's more complicated than you think. All right, but again, here, even during the worst of the Great Depression, getting up to the Gold Reserve Act, there was money printing only to the tune of 7% per year. Remember, the deficits can be huge. We can nearly double the debt with a nearly 100% deficit during certain periods. Money printing is a much, much smaller component of that. Now I'm going to go to the Nixon shock. Take off the deficits again. We're just looking at the money print. Basically, from the end of the Vietnam War, this is the full fiat standard started. Nixon closed the gold window all the way to the global financial crisis. Look at this. How much money was the Federal Reserve printing on a trailing 12-month basis? Because that's really what this is saying. Because the only thing that the Federal Reserve buys with its printed money is government bonds. This is something I probably should have said at the top of the video. I try to say it a lot. For large central banks in large developed economies, they're not buying even gold. They're not buying anything else. They're just buying the sovereign's debt. Okay, and thus they do create a price floor for other investors. Because if other investors wanted to try to short that debt or really didn't believe that the government could pay back that debt, the central bank steps in to create that floor. That's really what's happening, but they don't need to do a lot of money printing to do it. And as I said before, precisely during this period, this is when all of the economists that you see on TV today came of age. All right, from Larry Summers to Stiglitz to, to anybody on down. This was the great moderation. This is where everybody thought they had figured it out. Just a slow increase in the national debt, which is judged by the deficit line here. So an 8, 10, 11, 13% increase in the debt per year, or deficit spending each year. All right. Taxes came down. This was a problem for the government. But the money print was pretty static. The Federal Reserve thought that they had figured it out. All the economists that you're looking at today, the older economists, I should say, the older generation, they cut their teeth during this period, during the great moderation. Everything has just been figured out. But then, all of a sudden, even after Clinton balancing the budget, remember, what does a balanced budget look like? It just looks flat. Okay, here's the deficit right here, around 2000, it's going down. The deficit turns into a surplus. So instead of going up 2-3% a year, the deficit turns into a surplus. You take the debt down 1%, 2%, 0.7% per year on a trailing 12-month basis. Okay, that's what That's what a balanced budget looks like in the context of the rest of it. Taking a moment to remind you that this show is brought to you by Trezor, home of the original Bitcoin hardware wallet. For over 10 years now, Trezor means business in Bitcoin security and functionality. When using their wallet software Trezor Suite to connect to the Bitcoin network, you're automatically connected via Tor, protecting your identity and giving you full control of your coins in a fully open source manner, both on the software level and on the hardware level. So head on over to Trezor.io to grab your Trezor Safe 3 with a secure element, Model T with a touchscreen, or the original Trezor 1, as well as a ton of available accessories to back up your keys and keep your coins safe. This show is proud to be associated with Trezor. Again, the point I am trying to say with showing this is that it's much more complicated on the surface, and you would be surprised, in fact, how little relative to the debt the central bank monetizes it or prints. It's not much. Look at how little it was during the 90s. In June of 1998, over the trailing 12 months, the Federal Reserve only printed 0.5% of the government debt. Okay, so a very small proportion where taxes were, what was that, June 98? 30%. Right? Taxes were 30% of the debt. Each year, they were collecting 30% of the debt. But of course, they were spending more. Let's go back to 98. They were still spending 2% more than they took in taxes. They did have a balanced budget here. But the money print, look at the money print. It's a much smaller figure. Much smaller figure. Now, things get crazy here. Okay, the bailout of Wall Street, the Main Street bailout of Wall Street happened here. This is a little sleight of hand. The Federal Reserve actually decreased their money printing of government bonds during this period, but they were increasing. You have to see the whole picture. They were increasing corporate bonds. But of course, after this, they swapped out the bad mortgage-backed securities that were on the books of Wall Street with nice government bonds. And how did they do that? Well, they printed money. So the Federal Reserve here did what was called QE1, QE2, QE3. They basically put fresh, nice government bonds on all the books of the money market funds, the hedge funds that they were bailing out. Some didn't get bailed out, like Lehman, but most did. And the Federal Reserve, in return, took a just boatload of garbage mortgage-backed securities on its book, which the federal government, of course, took in as well under the agencies of Fannie and Freddie. So that's how it worked. That's how the bailout worked. It was a bailout for Wall Street, and they did increase on a trailing 12-month basis. They increased. But look, if you looked at it nominally, it would look kind of crazy, but as a percentage of the debt, still not so much, 12%. Remember, the deficit can increase a lot, and the deficit itself wasn't even that much during this period. The peak during the global financial crisis, remember all that havoc, only 22%. Now, we are starting to run into, I don't know if you call it the law of large numbers, but we are running into larger figures here. Okay, so when Clinton balanced the budget, it was $6 trillion national debt, all the way to Bush's final mess up. We doubled it basically, 12 trillion, almost 12 trillion, and that's a 22% increase. So these percentage increases, though they're smaller than the Civil War, World War I, World War II, they're much smaller, actually. Remember, the deficits, an increase in the debt, much smaller. The dollar figures are huge. And you will notice now the money printing is bigger. It's bigger, but it's still not huge. But now you can start to see that, let's look at the money printing relative to the deficit. It's nearly the whole thing. And this starts to show you, if you just look, for example, like right here, you see that the national debt is $12.1 trillion here in November 2009. Okay, so November 2008, everything exploded. November 2009, the federal government increased the debt 13.6%. 12.1% of that was printed. So here you can say that basically the entire deficit was printed. Okay, so that's how you would interpret or analyze these numbers. And it starts to be more and more relative to the deficit. So this is the kink in the armor. This is the conundrum that they're facing, is where, look here, let's go, I don't know, here. They could borrow a lot from the market And they did. This is private, war bonds and things. I mean, people, savings bonds. This is the public buying the debt. This black line increase. The Federal Reserve was buying a very small proportion relative to the rest of the government. Now, and even here, during the end of the Vietnam War, the Great Moderation, the Federal Reserve was buying a small proportion of the increase in the debt. Now you can see it's basically the entire deficit. Not the entire, but it's a lot of the deficit. So there's still taxes, which are here, by the way, in green. So as a percentage of the debt, those are also getting smaller. We talked about this in prior videos. There's still spending, taxes and spending, but the shortfall of that, the deficit, is mostly printed now these days, okay? So as a percentage basis, it's not still huge, all right, but mostly it is printed. You see this is the major trailing 12-month increase during COVID. The deficit went up, the debt went up 20%. The deficit was, I should say, 20% of national debt. That means the national debt increased 20%. The print was half of that. Okay, but from this point, from peak COVID, look at what happens to this line. Let's take the deficit away. Just look at what happens to this line. It's actually lower. It goes down. And I'll get to this as well in future videos, but on a nominal and a relative basis, the Federal Reserve is not printing money. Because remember, the Federal Reserve is not buying corporate bonds. They're not buying Facebook stock like the Swiss National Bank or the Japanese Central Bank. The only assets on their book, which you're seeing here, the only assets on their books as a percentage of the federal government debt is government bonds. They helped to increase the national debt 13.6% here in peak COVID times. And then it was a decrease of that increase to where it was even a full-on decrease. A decrease of the balance sheet when it was below zero from this period on a trailing 12-month basis, November 2022, Federal Reserve has been decreasing the money supply. It's been decreasing the amount of national, federal, United States Treasury bonds, bills, and notes that it holds on its books. Notice a similar phenomenon happened here in 2014 all the way until the global financial crisis. This is what I would keep in mind, all right? There were a lot of Bitcoiners, a lot of gold bugs that I heard that just talked about money printing during this period. But if you actually understood what money printing meant, money printing did not occur from mid-2014 all the way to the global financial crisis. It did uptick a little bit. Remember the repo crisis in September 2019? It did uptick a little bit here. But COVID exploded it, and now it's going down again. What am I saying? I'm saying there's nothing on this chart that shows we're going to have a drastic change tomorrow. But economics is complicated. If we go back to the Great Depression, we were also decreasing the debt all the way to the Great Depression. And, the Federal Reserve, again, it's a practice period for them, but they were up and down of how much debt they were buying or selling. Really, the problem was that they were lending too much at cheap interest to corporations, to banks and corporations. That was the problem of the Roaring '20s. You can't see that on this chart here. And even here, they're lending less money to the federal government. They are buying less government bonds, both on a nominal and a relative basis. So if you happen to read some talking head on the mainstream financial press or the alternative financial press over the last few months that said the government is just printing too much money, all they know how to do is print, the central bank is printing too much money, they don't know what they're talking about, because the Federal Reserve has not been printing money over the last 2 years. And that's what we're going to continue to explore here. I would just encourage you to think long term, think big picture. These percentage changes are much smaller, actually, than prior deficits have been. Okay, but it is true, and it's something to keep in mind, they are much bigger as a proportion of the deficit. All right, and I will show you that in a future video, because we need to put all of these things together, right? I told you I would do that. We have the money print, we have the deficit, we have the interest rate, and we have taxes. all expressed here in trailing 12-month percentage terms. The net of all of it is as the national debt has always increased, sometimes at a higher rate, sometimes at a slower rate. But if we want to try to see around the corner or understand a little bit more what all this means, we got to put all these figures together. And that's what I'll do for you in the next video. Hope this helped. Let me know if any questions or feedback in the comments. Thanks for watching.